Hello and welcome to the first Advanced Projections monthly report for the new year of 2023. This is for January. Let's review what happened in December and the first part of this month in our economic data highlights. First, employment figures for December came in with a still solid new jobs figure up 223,000, and unemployment moved back down to 3.5%. We expect that unemployment should eventually begin to gradually move upwards because at these low levels, the Fed must stay fully focused on inflation, as repeatedly confirmed by Chairman Powell, the FOMC, and other Fed governors. Annual CPI inflation through December was announced back on January 12th, with consensus expectations for it to be around 6.4%. The actual reported value was 6.5, just above the expected number. However, sticky price inflation, less food and energy, continued to rise. In November to 6.48% and December 6.60%. which is still more than 1.6% higher than 7 months ago and a bit higher than the general CPI number. The Federal Reserve added another 50 basis point rate increase to their Fed funds rate, now at 4.25% to 4.5% on December 14th. Along with that, they issued new projections for 2023 through 2025, and they are now looking for a longer fight against inflation with higher rates than they had projected previously in the year. Equities markets have gained as much as 10% since the October lows were put in, but are testing key resistance levels, and volatility indices are pointing at another downward move. The S&P 500 appears to be testing overhead resistance around 4,000. The overzealous market response to the previous 7.1 CPI reading back in December fueled another brief leg up in the temporary bear market rally, but it still closed down 240 points by the end of December. With the inflation figures out on January 12th, equities traded calmly, but are likely to resume their downward trend once the Fed's next FOMC moves and comments are digested, which are coming out right at the end of this month. Our indicator system keeps our recession risk level at 90% plus due to more steeply declining leading economic indicators, a continuing hawkish Federal Reserve monetary policy stance, and an ever-deepening red APYC yield curve indicator. There are now no AP indicators showing green, and only one, the AP FD Fed indicator, is just skirting the boundary between red and yellow. 11 months ago, in early February of 2022, advanced projections gave you an extreme risk warning for equities as the Fed was preparing to begin their quantitative tightening program in March. Here in the beginning of 2023, there is continuing evidence of significant moves to cash as reflected in the long-term bond market as people are realizing the resolve of the Fed in their long-game battle against the inflation dragon. That cash has fed some temporary bounces in equities, but that is not likely to stand up against all the true forces at play elsewhere in the economy. Now, here are the current underlying economic details. Year-over-year consumer price index increases, supply chain issues, and tight labor markets continue to plague many aspects of the economy. General expectations out just ahead of the January CPI announcement were for 6.4% inflation, but it came in at 6.5%. The Federal Reserve will not be swayed much by that number as the underlying sticky inflation numbers are not coming down, and home energy costs will have an upward effect on readings in months December through this coming March. The Bureau of Labor Statistics Employment and Federal Reserve's intentions, unemployment continues to remain well below 4% over the past 11 months, now at 3.5%, with new job gains in December of that number we mentioned, 223,000. We expect those gains to continue to dwindle for another few months in a restrained downward fashion. But we also expect to see an accelerating pace of layoffs begin this spring in 2023. We do show Table A from the BLS monthly report. Included in that report was mention of a slight increase to 10.5 million job openings through November. And for every unemployed person who is looking for work, there are still over 1.7 times that many job openings for the 6 million people who are unemployed. The current solid employment situation continues to keep the Fed free to be as aggressive as they deem necessary in their rate increase script, as well as in their plans for unwinding their balance sheet, thus decreasing the money supply. They have already stated so along with their 7 rate increases in the March through December timeframe, and within their last available FOMC meeting minutes. Look for continued activity in these areas when the Fed returns with their next steps at the end of January. Their December rate increase came in 25 basis points below our expectations, but based upon the coincidentally issued report, we do not expect any delicacy or wavering on their part in the beginning of this year. Expect at least a 25-point bump at the end of January, perhaps as much as 50 points, if they lend more weight to the still climbing sticky inflation value. There's a table issued in their report, which we show in our written report, shows exactly why to expect continuing Fed hawkishness. Note that in this table, all their projections made in September have been uprated in December to show higher interest rates and longer lasting inflation than they previously thought. Higher rates for longer means more braking on the economy, and they indicate more than a full percentage point higher unemployment from current levels as a consequence. In the energy picture, in 2022, the June through November 0.75% interest rate increases had already had a significant effect on the price of oil, driving it down more than 40%. This in spite of OPEC and Russia recently cooperating in an agreement, both financially and politically motivated, to restore their 2 million barrel a day production cuts to levels which were enforced during the first quarter of 2022. Global demand forecasts are having a greater negative impact now, with oil dipping significantly below $80 a barrel in the past 90 days. Natural gas prices may end their pricing breather that resulted from a fire at the Freeport, Texas LNG export facility. However, that facility is still experiencing a delayed return to service as regulators are demanding further safety reviews and additional requirements. Once this facility does return to production, LNG export activity will be back near maximum. That will also keep electric power production costs high, as natural gas accounts for about 40% of the U.S. generation mix. Gas prices should soon reflect the expectation for restored export activity, along with more major winter storm weather. California, the second largest gas-consuming state, is experiencing record-high natural gas prices, many multiples higher than the rest of the 48 states. Several new LNG facilities are under construction, and their export activities will keep upward pressure on natural gas prices and hence electricity as well. High natural gas prices have stimulated a renewal in well development, and there are now more drilling rigs in operation than there were in late 2019. On the supply side for natural gas, the exploration industry is beginning to complete wells that were unfinished during 2020 and 2021, and will put them into production over the coming months. However, we expect high natural gas prices to persist as long as Putin tries to hold Europe hostage with restricted natural gas supplies, and as long as reduced available supplies and stored volumes persist through the upcoming winter here and abroad. In equities, the recent lower CPI report of 6.5% injected a little more euphoria into the markets, but fresh negative news, perhaps from the Fed's view of the intransigence of inflation or a reversal in declining energy prices, may restore the downtrend. Of course, the other thing that could contribute to that will be the fourth quarter earnings reports that are coming out between now and our next report. We continue to expect significant further general declines in equities and bonds in the intermediate term. A return from the current index level just below bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 3000. Now, in a typical bear market, negative investor emotions carry enough downward momentum to drive indices significantly below their means, towards and through the inevitable retail investor emotions of despair and capitulation, when finally the selling ends. There's no current reason to expect anything different this time, as the Fed appears to be highly resolute in their attack on inflation. And that means more significant rate hikes, which should still be expected, beginning with the next one in late January of this year. They have clearly stated what their targets are, that inflation has not truly begun to respond as needed, and they are dead set against pausing or quitting too early. We have a long-term chart with actual analyst projected values for S&P 500 earnings and revenue growth that cover the years 2017 through this year, 2023. Our markup on that chart shows where we think they have miscalculated, similar to what we did in the middle of last year. The first test for the analysts will be when fourth quarter of 2022 earnings are out in this January-February timeframe. If they miss expectations en masse, it becomes more certain that 2023 will be weaker than currently expected. Fourth quarter 2022 corporate earnings for the S&P 500 outside of the energy sector will likely show an aggregate negative growth. Those numbers will just begin to come forth as this report is issued, so a much better picture of earnings will be found in our February report. If they show the declines we expect to see, then the equity indices should resume their declines as well. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. The November number, which is always a month behind in the reporting date, for this metric was down another 0.9%, bringing the year-to-date decline for 2022 to minus 36%. Risk capital has clearly made a serious exit from the markets. A bottom may be near on a historical basis when margin borrowing declines a full 50% from its previous high. So there is still a long way to go. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.